Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of LME 3-month lead and tin. I'll start with LME 3-month lead. The last of the main drivers here since late spring and throughout summer, as well as going into autumn, has been the construction of the June to date double bottom pattern. It's a lopsided bottom, but it is nevertheless still there. The market has most recently been scaling upwards on the second part of the double bottom. Prices came ever so close 2 weeks ago to confirming it as a pattern, but bottled it in the middle of the week. As I said 2 weeks ago, to justify such a pattern, and I quote, you would need at the very least prices to exceed, and properly exceed, the 50% Fibonacci line of the June to October 2018 move at 22.21, end of quote. Well, prices did not manage that, dropping down either side of the slowly declining long moving average, currently at 21.14, and testing a newer support. You see, 2 weeks ago, I drew a late September to late October bullish Andrews pitchfork, which is highlighted in dark blue on my daily chart. As I said last week, and I quote, this is a very steep looking one, so its lifetime may be limited. But up until now it works, though the market is currently testing the lower time, that's currently at 21.61. I am quite prepared should this bullish Andrews pitchfork fail to draw a shallower bullish shift pitchfork in its stead. But first let us see if this bullish Andrews pitchfork holds. End of quote. Well, today I have drawn that shallower bullish shift pitchfork, not highlighted, not yet, but the market is nevertheless in between the middle time below, currently at 20.83, and the upper time above, currently at 22.42. The reason why I drew it? Well, it's simple. Prices are breaking through the lower time of the bullish Andrews pitchfork, and that is why. So, we wait and see if the bullish Andrews pitchfork repairs itself, or if we shift focus to the shallower bullish shift pitchfork. Thus, there is still a bullish incentive overall, just a potentially different one. LME 3-month tin. The story since late June has been a series of stratified support levels that in late August became a series of stratified resistance levels. The major ones overhead are at the following levels: between 23,000 and 24,155, 21,360, and between 20,435 to 20,510. More recently, the following levels acted as support. In October, the market broke down through these levels before turning back up again and recovering and becoming support again. These are at 19,270, 18,810, 18,590 and 17,525. The descent ceased in early November and the market turned higher, prompted by congestion at 17,525 and just ahead of the September 2020 low at 16,970. This pullback overcame some, to be honest, lightweight resistance, but then tackled and punched through the slowly rising short medium moving average, currently at 20,335, the slowly declining medium moving average, currently 21,925, and pushed up into some of the banded area of resistance I'd previously mentioned, between 23,000 and 24,155. The slowly declining mid-November was the high water mark for this move up, with prices pushing up clear through the congestion band, but soon running foul of another older congestion band between 24,750 to 25,050, dating from February 2013. The market peaked with an indecisive doji cross, but a doji cross that was much more, as it was day 2 in a 3-day bearish evening doji star pattern, and prices dropped down to close early last week below the medium moving average and on the congestion at 21,355. Yet this did not last, as since then there has been a gradual erosion of resistance and a turning of the medium moving average from resistance into support, for maybe an attempt higher into those stratified resistances that we see overhead again. There's one final thought I'd like to reprise once again. 2 weeks ago I said, and I quote, the action since late August has caused me to think that perhaps the action is a possible descending scallop pattern. I would like to see more on this to be sure, but right now it looks like a lot like that to me. I'm minded therefore to just give just a provisional idea on the upside for such a pattern, assuming of course it does not peak and revert back down, which would also be in line with this pattern. But for a continued move higher, you'd have to look primarily in the 25035 area and possibly later on, should it continue, up to the 27475 area. I'm not ready as yet to start naming targets for this pattern, but it is worthwhile being prepared just in case, as I can easily discard these if they prove unsuitable. End of quote. I am still minded to look at that action as a possible descending scallop pattern, as the fall last week was in line with such a pattern. However, I think I will discard the potentials, not targets, but potentials I've previously mentioned until a better picture emerges. If we do see a resumption of the significant move lower, then for this pattern to survive, it must not be more than the low in late October of 17,350 and ideally no more than 17,525. Therefore, this pattern is still in operation. Just pay close attention to what happens next, as it will affect any fresh potentials on the upside. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright Tofpik and ADM Investor Services International Limited. And here comes the final bit.